Welcome to the Explainer. Today, we're going to break down a really interesting accounting rule that flips a normal expense right on its head and turns it into an asset. We're diving into IAS 23 borrowing costs.
So let's just jump right in with a question that on the surface seems almost too easy. A company borrows money, they pay interest, so that interest is an expense, right? It lowers your profit. End of story.
And you know what? Most of the time, you would be 100% right. For all the normal day-to-day stuff, working capital loans, buying a piece of equipment that's ready to go, yep, that interest cost just hits the income statement as a regular expense.
But what about the really big projects? I mean, think about building a giant factory or a bridge or something that's going to take years to finish. If a company is shelling out millions in interest for a loan to build something that won't make a single penny for years, does it really make sense to expense all that interest right now? Well, that's exactly where IAS 23 comes into play.
The whole secret to this standard, the entire core idea, really boils down to this one specific concept, the qualifying asset.
And here it is, the core principle of the standard. It basically says that some borrowing costs, we're talking about interest here, don't get treated as an expense right away. Instead, they get capitalized. Now that's just a fancy accounting word for adding them to the cost of the asset itself, right on the balance sheet.
So what is this special asset that gets this treatment? Well, it's called a qualifying asset. And the key phrase to remember here is substantial period of time. This isn't for things you can just buy off the shelf or churn out in a couple of weeks.
This table lays it out pretty clearly. Over on the left, you see the big, time-consuming projects. A bridge, a power plant, a custom-built machine. And on the right, you've got things that don't qualify. Inventory that's made quickly, equipment you can just plug in and use, stuff like that. The real dividing line is that substantial period of time it takes to get it ready.
Okay, so let's say we have one of these qualifying assets. The next logical question is, how do we figure out exactly how much interest to add to its value? Well, it all depends on where the money came from.
IAS 23 basically gives us two scenarios. The first is specific borrowings, where the company took out a loan for this one specific project. The second is general borrowings, where the project was funded from a general mix of loans the company already had.
Let's tackle the easy one first. Specific borrowings. This is super straightforward. Imagine a company borrows $10 million, and the loan agreement says this money is only for building a new power plant. The link between the loan and the asset is crystal clear.
Now here's a crucial detail. You don't just take the total interest paid and slap it onto the asset's cost. You take the actual interest you paid on that specific loan, but then you have to subtract any money you earned by, say, putting that borrowed cash in a savings account before you spent it. It's the net cost that gets capitalized.
So for instance, one of our sources gives an example where a company borrowed $10 million and paid about $1.37 million in interest. But before they spent it all, they temporarily invested the cash and earned a little over $50,000. So you take the interest cost, subtract that little bit of income, and you get this number here. That's the amount that gets added to the assets cost.
Okay, but what if there wasn't a special loan? What if the company just used money from its general pile of debt? This is where it gets a little bit trickier, because now we have to figure out a fair way to assign a chunk of the company's total interest bill to this one specific project.
And the tool we use to do that is something called a capitalization rate. What we're really doing here is calculating the company's average interest rate across all of its general loans to find a fair rate to apply to our project.
Because, let's be real, a big company doesn't have just one loan. They might have a long-term loan at a nice low 9%, but also use a bank overdraft that costs them a whopping 18%. We can't just pick one, we have to blend them together.
By taking a weighted average, factoring in how big each loan is, we can land on one single blended rate. In the example from our source material, that rate turned out to be 12%. So you then apply this 12% rate to the money you spent on the project, and that tells you how much borrowing costs you can capitalize.
All right, so we figured out how to calculate the costs, but that's only half the story. We also need to know when to do it. You can think of it like a stopwatch. There's a very specific time to press start and a very specific time to press stop.
The standard lays out a really clear timeline for this stopwatch. You've got commencement, which is when the clock starts ticking. You've got suspension, when you might have to hit the pause button. And you've got cessation, which is when the clock stops for good.
Now, you can't just start that clock whenever you want. All three of these conditions have to be met. 1, you have to be spending money on the asset.
2, you have to actually be paying interest. And 3, you have to be actively working on the project. The very first day that all 3 of those things are happening, that's your start date.
And here's where it gets nuanced. What if work stops? Well, if it's a delay that's a normal, expected part of the project, like waiting for high water levels to go down when you're building a bridge, the clock keeps ticking. But if work stops for a long time for some abnormal reason, like a sudden legal battle, you have to hit the pause button. You stop capitalizing and start expensing the interest during that pause. Finally, you hit stop. The clock stops permanently when the asset is substantially complete. This just means the main work is done and it's ready to be used, even if there's still some minor touch-ups or administrative tasks left. Once it can do what it's supposed to do, you have to stop capitalizing interest.
So, after all these rules, qualifying assets, capitalization rates, starting and stopping clocks, what's the big picture here? Why should we care about any of this?
Well, the real impact is all about how a company's financial story is told. Instead of having a massive interest expense dragging down profits while the asset is being built, the company adds that interest cost to the value of the asset on its balance sheet. This actually gives a truer picture of the total cost to get that asset ready. And then that capitalized interest gets expensed slowly over the asset's useful life through depreciation.
And this all leaves us with one final, pretty interesting question to think about. Since capitalizing borrowing costs means recognizing less expense on the income statement during those long construction years, does this accounting rule actually make companies look more profitable in the short term than they otherwise would be? It's definitely something to consider.